Hello, everybody. Producer Wealth here, and today we're going to be talking about inheritance tax, specifically for those moving to Gibraltar, or thinking about moving to Gibraltar, or even those who are already living in Gibraltar. So, on this subject, we always say great news, no inheritance tax in Gibraltar. Super news. People are really pleased with that one. The bad news, and there's always bad news, is that if you're moving from the UK, then you're still liable to UK inheritance tax. Those rules have changed very recently in the autumn UK budget. Paul, can you tell us about those changes?
Well, everything is still murky and unclear. To be to be perfectly frank, they're entering a consultation period, and we have an idea of how it might work in practice, but during this window of opportunity, they might decide to tighten the rules even further or relax them, and that's what we don't know. But it would appear that what they're trying to achieve is we're transitioning from a domicile regime to a residency regime. During that period, and once you've been, I think, out 10 out of 20 years, correct?
Correct, yeah.
And that includes prior to the changes, yeah? If you've
Yes.
been out, then you're deemed not liable to UK inheritance tax, except that they now appear to be including UK pensions and overseas pensions, which are governed by Section 157 of the UK Finance Act 2004, to be still subject to UK IHT. You can correct me. So, in other words, if you exit the UK, and even in the case where you've done your 10 years of non-residency, if you have UK cited assets, those assets could potentially be or are considered um, part of your estate and subject to UK IHT, notwithstanding the fact you've been more than 10 years outside of the UK. Is that correct?
That is, well, correct. I'm not sure if that's the right word, but that's our understanding. So, yeah, I think they've moved from the domicile to the residency regime, which will probably be a little bit clearer in time, in the sense that domicile, we've spoken about this many times in the past. It's complicated, it's difficult to prove, whereas residency, at least there's a time span on it. But post that 10 years, yeah, Paul, this is where it's a bit because they're saying, well, you will still be liable for inheritance tax on your UK assets. Now, if it's a UK property, I think we can say with pretty much certainty that that will be included. A UK pension, such as a SIP, will that be included? It seems to indicate that will be the case. An overseas pension, will that be included? We kind of move down there. They seem to be suggesting this will be the case, but it's not very clear. And um, they've mentioned it will apply to a QNUPs. This one I find very strange because for those who don't know, a QNUP stands for Qualifying Non-UK Pension Scheme. So the name is Non-UK Pension Scheme, but then they're saying it's a UK asset which they will tax for inheritance tax. How does that one work?
Well, they were very clever, actually. All they did was to remove the IHT exemptions on pensions. And because the QNAPS is still a UK pension scheme or falls under within scope of this provision within the Act, then it was captured by the changes. So you're right. Look, qualifying recognized, and the keyword is overseas. But they have said, okay, both schemes are born out of UK legislation, both are recognized in the UK, and they're therefore and registered in the UK. I think they argue. So
Yeah.
they're UK pension schemes, and I think the later the what I keep hearing now regarding this particular point, will the pension be deemed liable for UK inheritance tax, notwithstanding you've already effectively exited for more than 10 years? And I think many practitioners have come to the conclusion, rightly or wrongly, because, Matt, we do not know, that it will all depend on the double taxation treaty that the UK has with third countries. And in some instances, some double taxation treaties remain silent on the issue of inheritance tax, who's got the taxing rights. For example, the double taxation treaty between the UK and Spain is silent on inheritance tax. That is really bad news, because if it's silent, then the UK will say, we will tax you.
Yeah.
And frankly, I haven't looked at the Gibraltar UK double taxation treaty to see what arrangements are in place. Again, if it's silent, not great news if what we keep hearing is correct, that then it falls into scope. If there's provisions within that treaty or agreement that makes it clear that the taxing rights fall on the country where the individual is tax resident, then great. I mean, that would bring a lot of clarity to the issue of UK pensions being subject or not subject to UK IHT after 10 years. But yeah, again, another of those issues where we wait to hear from the UK government after the 12 weeks have elapsed to see what further guidance they issue on this particular point. And then if it's dependent on double taxation agreements, then we would have to look at each and every single double taxation agreement where our clients are um, affected and establish who has taxing rights. So again, it's, I think, hanging on a cliff edge. Um we have
It's
to
a
wait.
it's a wait and see. Time will tell. But I think for me, out of all the recent changes in the legislation that came out from the budget, I think this for me is the one that's, maybe it's because we have a vested interest, but it's the one that is the most unclear. And speaking to other people in the profession, or seeing these articles online, or people on platforms such as LinkedIn, it seems the interpretation is completely different. Some are saying, I saw somebody online saying, well, because now if you live in Spain, for example, you have to pay 25% to transfer your pension to a QOps. But they were saying, well, you pay the 25%, but then you save your 40% on inheritance tax. And so they're suggesting it's out of the scope. But most of the articles are suggesting, so it really is unclear. And I guess I think that's, I guess, a big issue with the budget, that they seem to kind of rush through these proposals without really maybe going through the finer detail. They put them through and they're waiting for the reaction, and they're gonna amend it to that. I'm not sure.
I think they'll try and clean it up if there's any grey areas, but it is, I mean, we're talking about Gibraltar. I don't want to digress to Spain, but it really kills pension transfers to Spain,
Yeah.
because there's an overseas transfer charge, and then Spain taxes you on the full amount as if the whole amount was income. So in a nutshell, really all you can do is to transfer it to an international pension scheme. But I guess we'll cover that when we do our videos on Spain and how it's been impacted by the UK autumn budget. Um,
Yeah,
it's
absolutely. And I think we spoke about this before, but we will have to, for the viewers, release another video after this consultation period, because then we will know. And will we be trawling through double taxation agreements? Will it be a lot clearer, and they will say this is in and this is out? So yeah, keep posted for that. I think it's around the 12th of January. Is that right? The consultation period
I,
ends, or mid-January, something like
I
that.
think roughly around those dates. But
Yeah.
Matt, is the same. I'd like to just emphasize the same thing. Do not miss out because you procrastinate.
Yeah.
These things are changing very rapidly. All governments are in need of additional tax revenue because they're running deficits, and they are looking at every which way that they can tax you to cover the shortfall. And if you're sitting there on an opportunity to transfer a pension and you're out of laziness, you just wait and wait and wait, it might be too late. You're going to miss out. So really, check those pension schemes. You know, if they're in boxes, take the dust off, look at the fine print, give us a call, and I'm sure that we can give some direction.
Yeah, I think it's this situation where it really pays off to have a kind of professional in your corner because, we can navigate this as well. And even if there are changes, we're kind of prepared for it as well. So, no, you're right. I think for those in Gibraltar are looking to move to Gibraltar, you really have to kind of pursue definitely your pension transfer as soon as possible before there are more changes in the spring budget, which is historically a lot more aggressive than the autumn one. So no, I think I'd agree completely with that one, Paul.
Yeah, be proactive, not reactive, because if you're reactive, it might cost you a lot of money
Yeah,
over a long period of time. And if that's your retirement pot built over 40, 50 years of hard work, I mean, it's and then when it comes to retirement and you're going to enjoy the fruits of your labor, you find that you're being taxed left, right, and center. You know, this is not something to delay and delay and continue to delay. You have to act,
yeah,
and it's worth reaching out. As you say, you really do need. I like those words, Matt. You really do need a professional on your side to be able to steer you in the right direction.
absolutely. And I think one thing people maybe underestimate is people moving to Gibraltar. Yes, Gibraltar is very generous when it comes to taxation, but if you don't structure your assets to take advantage of that, you're not really taking advantage of it. So, look, there's some planning to do. Maybe it's not the most exciting thing to do when you're relocating to a new country in the sunshine, but that's what we're here to help you with at Fiducia Wealth. So, if you are in that situation, give us a call, drop us an email, and we'll arrange a time to speak to you. But for now, we'll speak soon and thank you.
Thank you.
Bye bye.